Hello, everyone. Welcome to today's Practitioners Insights webinar on climate transitions, risks, and opportunities, hosted by CFA Institute. First and foremost, a very warm welcome to all the audience joining us today from different parts of the world on a very engaging and interesting discussion on a topic which is relevant and pertinent today. I am Pankaj Sharma, moderator for this webinar. I work with CFA Institute and I lead capital market policy for CFA Institute in India, focusing on policy matters related with issues across a broad spectrum of capital market topics and subjects related to impact on stakeholders. Before I introduce our speaker for today, I have a couple of housekeeping notes. Today's webinar is scheduled for 60 minutes, including the Q&A, around 40-45 minutes for the presentation by our speaker, and then about 15-20 minutes for the Q&A. So we'll be leaving enough time for Q&A. Please feel free to submit your questions throughout the presentation, and you can do so by quickly clicking on the Q&A icon at the bottom of your viewer and typing your question in the box. We immensely value your feedback, so please complete the evaluation survey before you sign off today. Now it's my pleasure to introduce our speaker for today, Dr. Gireesh Shrimali. But even before I do that, I would like to congratulate Dr. Shrimali for making it to the 2024 top scholar list of Scholar GPS. It's a great and significant achievement because this puts him in the top 0.5% of this coveted cohort in the group. Congratulations, Dr. Shrimali. Talking about his work and his profile, Dr. Shrimali is the head of Transition Finance Research at the Oxford Sustainable Finance Group, Oxford University. His current research focus in the policy, economics, finance, and technology of energy, environment, and sustainable development. In particular, he is focusing on the key issues of net zero transition and climate risk assessment. You will learn a lot more in his presentation. His past research has focused on the design analysis, economics, and policy of networks and distributed systems, which followed his significant experience as a system architect and a design engineer in the semiconductor and network industries. Dr. Shrimali earned his PhD from Stanford University and his MS in electrical engineering from the University of Minnesota. He obtained an undergraduate degree in engineering from the Indian Institute of Technology, Delhi, IIT Delhi. A very warm welcome, sir, and it's a pleasure to have you with us today. I'm sure that our audience is eagerly looking forward to your presentation and will have a great experience listening to you. So without further ado, over to you, sir.
Thank you, Pankaj. Can you hear me?
Yeah, we can, sir. We can.
All right. Okay. All right. Thank you so much. So let me get started with this talk. And before I get into the uh, actual topic of the conversation, I wanted to give you a sense of where I'm based right now to provide the context. So I am currently based at the University of Oxford in the UK. And I'm part of this group called Oxford Sustainable Finance Group. And this group is a pretty significant group, and it works at the kind of the intersection of business and climate, and especially finance. And we obviously engage in a lot of research, but we also have education related program connected to executive education, but also we also provide some free education to the public and the third sector. We also have a significant presence in terms of a physical space where we invite collaborators and other stakeholders to join us. And in that context, we are about to hold our annual conference, which is called the Sustainable Finance Summit in mid-July, July 16th and 17th. In terms of my own work, I focus on essentially three different areas of work which are shown on the left-hand side. The first one is called the environmental stress testing and scenarios. and that has to that focuses on climate financial risks and their implications for companies and financial institutions, and that's the area that I'll focus on today. I also focus on two other areas. One is called the net zero transition plans, which is somewhat complementary to climate financial risks. And that has to do with managing risks as well as creating strategies around net zero transitions. And finally, we also look at this whole issue of cost of capital and the drivers of cost of capital, as well as how cost of capital enables transitions in the real economy. So these are kind of on the left-hand side of the three main areas that I work on. And these are all basically global initiatives. We look at multiple countries across the world. But I have also recently started a new program called the India Transition Finance Program, which is focusing purely on India. And this is bringing in my expertise from the past, as well as India's kind of key role um, in the kind of the ecosystem today, in the global ecosystem today. And in this program, we basically focus on all these three areas of research that I've highlighted on the left. Um, what I wanted to also talk a little bit about is this whole notion of what is climate related financial risks, and wanted to give you a very high level overview, because towards the middle and the end of the talk we'll get deeper into this concept. But the basic idea of the climate related financial risks is that there is a likely financial impact or a potential financial impacts arising from climate change. And this is uh, typically categorized into two different categories. One is what we call the physical risk, which is more towards the bottom of the slide, which is has to do with as the climate is changing around us, and we all know that the temperatures are rising and global temperatures are rising, and therefore it has an impact on our broader climate, but also environment. So there could be impacts on long-term impacts on, for example, crop yields or productivity. And so that's a physical impact, but there could also be in terms of increasing intensity and severity of um, basically climate events happening like floods or even heat waves that have impact on, for example, let's say take a power plant. If there's like floods and there's a significant flood, it could shut down a power plant or reduce the capacity to produce, and that has impact financial implications. So that's kind of the physical risk that's kind of somewhat easier to get our hands around. And then there's also the notion of transition risk, which has to do with as countries and stakeholders are realizing or recognizing the likely impact of the climate on in a physical manner, there's also a reaction with the changing policies, changing markets, with the different technologies being introduced and becoming more cost competitive, etc. And this risk, which has to do with the transitioning of our system kind of in response to the changing climate, is called transition risk. And here is what we'll get deeper into towards the middle and the late part of this talk. And the basic idea here is that why we are talking about climate risks, it's because climate risk could be of interest and could be substantial into investment and lending decisions for financiers, but also for real economy companies. So that's why it's important to look at this. And by the way, one other thing I wanted to also highlight is that when we're talking about risks and impact of climate, it's not just it is risk from a negative perspective. There could also be opportunities for certain actors to kind of kind of improve their financial standing, and we'll talk about this as well. All right, so when we look at the financial impacts from climate risk. And this slide gives you a more kind of detailed view, right? On the left-hand side, what I'm talking about is these are phenomenon that are occurring on the physical side of things. You can look at wildfires that are pretty much a big concern in something like California. There could be heat waves, there could be floods, there could be storms, etc. And then on the transition side, we could have policies, technological change, and also sometimes the markets themselves shift because of sentiments, either consumer sentiments or investor sentiments. And what all that does is that because of this changing environment, um, there are transmission channels that either have microeconomic impacts on individuals, households, firms, but also have macroeconomic impacts on countries and states as a whole. And then these transmission channels eventually could lead to financial risks. And in some sense, one could say that the climate risk is a separate risk, but typically climate risk will factor into the well-known kind of the channels or kind of the factors that go into financial risk assessment, for example, credit risk or market risk or liquidity risk. So what we're going to do in this talk is potentially look at the impact of climate transition risk onto how valuations of companies might change because of the transition risk that we see in India. And obviously, there are a lot of sources of variability and uncertainty into this analysis. So a lot of time, this analysis is done from a kind of a scenario perspective where we look at different scenarios and we look at what happens under this scenario, which is what the financial sector is pretty used to. And I'll give you slightly more details as we go along. I just wanted to also highlight, in case you're interested, and if you are specifically looking at this aspect in your work or in your research, as I had mentioned, that I lead work on three major areas, and within the environmental stress testing and scenarios, where we look at developing methodologies, creating data sets, and also creating applied research. We have a web page where we kind of list all of our work. And what I've done here is that I've listed some of the outputs that could be of interest. And in particular, what we try to do is that we try not only to produce research outputs, but we are also trying to create discussion papers that are kind of useful for practitioners. We are also trying to create tools that are useful for practitioners as well as regulators. And the idea is that we want to provide a kind of a comprehensive set of support to various stakeholders so that they can make better decisions. So the kind of at the end of the day, the focus remains on providing support to decision makers. But what I wanted to talk a little bit about is this tool that we have developed, and it is on our webpage. And I'm happy to um, kind of guide you towards it if you're not able to find it. The idea was that in one of the papers, which we actually produced with um, a researcher, Raymond Pang at the CFA Institute, who is based in the UK. The idea was to look at if there are risks and changes happening at the real economy level, how might those risks propagate through the financial system? Because the idea is that if there are losses or changes in the financial health of companies, that might translate to financial impacts on the banks and the equity investors that are investing in those companies, but also because the financial system is interconnected, those losses could propagate, and therefore this tool could be of interest to regulators. And this tool, what it does is basically it's models given a particular shock to the system, how the risk might propagate, and you can play around with that in different ways to see and obviously it requires um, actual real data to be more realistic, but we have also used some kind of um, mock data to show you how this tool operates. It's a very useful tool. All right, so now what I wanted to do is to kind of shift gears and come to India and focus purely on India. And just to set the context, even though I've talked about climate risks, I've talked about physical risks, I've talked about transition risks, what I really want to focus on is transition risk within the power sector in India. But I'll give you a little bit more context before we get into that. So going back to the physical risk side of things, just to kind of highlight, India is one of the top 5 countries in the world most exposed to rising temperatures. And as I've said, and this chart shows how the temperatures are likely to rise under different scenarios that are being postulated. And what this brings about is that you might see, as I said, an impact on crop yields and an impact on agriculture, but it could also have an impact on floods that could happen with a higher intensity and higher severity, therefore having impacts on real estate values or even um, agriculture asset valuations. And so, in some sense, the looking forward, the human and economic costs of climate change will only increase. And there are studies that show that if we stayed on the regular course, there could be a significant impact on GDPs, including India's GDP, and it's up to 10% per year as we get closer to the mid-century and the end of the century. So that physical risk aspect for India is actually even more significant compared to some other countries, and we need to be kind of thinking about that. The other one is, as I had discussed, which is the transition risk part, which is kindly mostly connected to a proxy called emissions and emissions from the fossil fuel based sources. In some sense, could be taken as a imperfect proxy for transition risk. And you could see that in India, given that India is the third largest greenhouse gas emitter, the transition risk is likely to be significant for fossil fuel based companies. And and given that India has made commitments on in the global forum, including in the nationally determined contribution, and at least there's a stated goal of net zero emissions by 2070, with some implied faster transitions for other sectors like the power sector. Then there's also discussions around the power sector going to net zero by 2050, and that has implications for fossil fuel based emitters in India. Um, and how is now coming closer to qualitatively, how is the climate transition likely to manifest in India, and in particularly for the power sector? Um, as the Indian policy and the Indian markets shift to higher renewables, and also India is starting to adopt the carbon pricing regime. The it is likely that the percentage of generation from fossil fuel based generation would decrease, and the percentage of generation from renewables would increase, and that will have implications for cash flows and therefore financial metrics. And that's the basic idea that we're going to pursue throughout this talk. Um, Now, we could also talk a little bit about, because this question also comes, is that, okay, there is a potential climate transition risk and broader climate risk that companies and financial institutions should think about within India. And potentially there are opportunities for companies on the other side of the equations. What's really happening in the policy and the regulatory arena, which is what I have kind of alluded to, but this slide provides kind of a somewhat of a comprehensive overview. I already talked about the national climate commitments, which is on the bottom left. I've also talked about the carbon markets, which is on the bottom right. But even the financial regulators, because the two are more connected to the real economy, I would say. They're not directly targeted towards the financial economy. The financial economy will see these impacts of these bottom two only through some analysis. But also, what we started to see is that the financial regulators, like the Reserve Bank and the SEBI, have started to ask for regulation, and they've put some regulations and some requirements in place, or at least guidelines in place, which are hopefully becoming regulations that require companies and financial institutions to at least assess their climate related risks and opportunities, um, and also in some sense um, develop strategies for addressing these changes that are supposed to come about. And this is all happening now. So it's as Pankaj has said, it is all very timely to kind of start thinking about it and start thinking about how we might be able to approach the issue of assessing what is likely to happen under different scenarios. And that's pretty much the kind of the goal of climate risk assessment. Um, Now, what I'll do is in the last about 20 minutes or so, I'll kind of walk through some of the recent analysis that we have done. And as I had said, we try to look at climate transition and climate physical risks to power companies in India. And while we do focus or we do look at physical risk in some of this work, and there's also some complementary work that I'm not talking about today, most of the focus will remain on transition risk. And what we have tried to do is we have tried to approach it from many different angles. We have done some what we call ex post analysis, where we look at what's happening in the past, right? Has there been any impact of climate transition risk on uh, companies' financial performance? And I'll talk about that, and that's the box on the left. But the main focus is we want to look at what will happen to companies going forward, and that's what I'm calling the ex ante analysis, which is in the middle and the right boxes. And I'll kind of walk you through it, but the whole idea is the middle box is focusing on a sector-wide analysis in a broad manner, using a tool that has been developed in collaboration with Thea Finance Lab. And then on the right-hand side, we look at specific firms as opposed to a kind of broad sector-wide analysis, to see can we replicate some of these results at the firm level using just Excel-based models. And so that's why I want to kind of introduce you to all three to get a sense of how this analysis is typically done, and hopefully that is useful to you in your daily life. So let's just talk about the ex post analysis, and this is typically a very academic view, so I'm not going to spend too much time on that. But a question always gets asked, like, have we seen any impact so far? And what we try to look at it is what's the impact of climate risk on probability of default for Indian power firms. And the idea is we look at this metric called uh, market implied probability of default, or market implied rating, that is developed by Moody and others. And that's the kind of the dependent variable that we look at, and we try to see if physical risk or climate risk has any impact in the past. And the idea is, as I mentioned, that we want to see not only the impact of individual climate or physical risk, but we also want to look at the intersection of those two risks. And this analysis allows us to do this, and this is called the composite risk that we want to look at. And the goal obviously is to, as I said, we want to look at what happens to the credit quality of these power companies, and it's measured by the market implied rating of companies. So without further ado, this is the result. And on the right hand side, it's primarily some regression results, but there are also represented in the graph on the left, which is what I'm going to talk about. So what we see is the first value where we see the impact of GHG emissions or the greenhouse gas emissions on the dependent variable, which is the implied rating. We do see a negative impact, and it's pretty, the size of the impact is pretty high, but we don't find it to be statistically significant. So that value could be kind of, should be taken with a grain of salt. But then what you start seeing is the middle one, the physical risk impact. That is already seen in the implied ratings, and that's significant. And finally, what we see is that if we look at the interaction on the graph of the transition risk, which is proxied by greenhouse gas emissions and physical risk, then we see a statistically significant impact, which is kind of showing that the composite risk matters, and these risks kind of amplify each other. But anyway, this was to kind of show you that what happens when you look at the past. But again, you guys know that in finance, past is not a predictor of future, and this is very much true in climate. So we need to do some forward-looking analysis, and that's what we try to do in this work that I'm about to present. And this is a paper that's also available. And what I've tried to do is it's a pretty technical paper, but I've tried to keep it to high-level takeaways. Um, but to give you some glimpse of the technical complexity, there are a couple of slides that I'll quickly walk through and try to give you some intuition. So this is the analysis that I'm just about to talk about. Is we're looking at pretty much all the power plants in India at the asset level, and we're trying to see what happens under climate transition. Okay, and we're trying to assess the impact. So the workflow is on this slide, and I'll take some time explaining it because there are some technical terms here. So what we do is first we start with assets in India on the left hand side. Then what we do is we use some scenarios, and as I said, given the uncertainty involved in climate projections, typically the analysis is scenario analysis. So we use the scenario that are developed by Network for Greening the Financial System, NGFS, to do kind of assessment of financial impacts. We look at multiple scenarios from multiple providers. So when I say multiple scenarios, we're looking at current policies, which is CP. That's the CP. We also look at net zero by 2050, which is the NZ 2050 scenario. And then we also look at net zero by 2070, which is also known as the B2DS scenario. So these are the three scenarios we extract from NGFS, and we use two different models. And these are models called GCAM and Remind. And I'll tell you why these models are important. These models are also called the integrated assessment models that basically model how the economy and the energy system will evolve over time. So now that we have the left-hand side in place, the basic idea of this analysis is that we want to see how a company is doing in the current policy scenario, which is the baseline, and then compare it to a climate scenario. And the climate scenario is either you look at net zero by 2050, or you look at net zero by 2070. And then there's another twist that we put into this, which is kind of a second order effect, is we also look at how the transition might happen. Is the transition happening now, or is the transition happening 5 years later? And that's what we call shock. But the basic idea remains the same. We are trying to figure out the change in net present value for a company um, under the baseline scenario, which is current policies, and a climate friendly scenario, which is either net zero by 2050 or net zero by 2070. And then we also introduce some shocks. But at the end of the day, what we want to do is we want to look at what happens to these NPV changes or net present value changes between the baseline and the kind of the shock scenarios. So that's the basic idea. The workflow in terms of calculating it, just quickly again, what I want to show is that there are multiple layers of this model, and there's also a source code for this that if you're interested, you could download, and the link is actually on the slide. It's the 1 in 1000 T-risk model. What the models are doing is they're creating a state of the world as it's progressing forward, a state of the world as a combination of the energy system and the economy kind of tightly integrated. And that is what the scenarios provide. The scenario output could be what is the production, for example, from coal power versus renewable power. And that's the kind of output you get from the layer one, right? Now, what you want to do is you pass those outputs that are coming from the layer one through the layer two to see what is the actual impact on firm level kind of drivers of cash flows, right? So, as I said, one of the examples is that there could be a change in production of coal power totally. And that might translate down to how much a company is going to produce. And therefore, that has an impact on income and therefore cash flows, right? So that's the middle box that is trying to calculate what's the impact on cash flows. And then you want to take the impact on cash flows, and in layer three, you want to start calculating the financial impacts. In this case, as I said, we're just looking at changes in NPVs, and we are basically looking at equity value impacts. And you can calculate that, and basically asset managers might care about that if they're looking at allocation of assets across different asset classes. But also, these cash flows could be used to assess the impact on probability of default or the kind of credit quality of a company. And while we haven't done this exercise here, we have done it in other papers. And eventually, if you can get a sense of what is the impact on a company, then you can translate it to a portfolio level impact by aggregating the impacts at the company level. So that's the kind of the basic flow that I wanted to kind of walk you through. Obviously, there are a lot of details here, and I'm not going to talk about all of that here. Now, another slide that seems somewhat technical, and what we have done is, and this gives you a sense of the broader analysis and the complexity of analysis. And you also have the slides, so you can go back and look at it and kind of reach out to me if it's useful. But very high level, what I wanted to highlight here is what you're seeing in the graph is a change in NPV, and that's what you see on the x-axis. And you have a value 0, and then you have positive and negative values. So the point is that you're seeing both positive and negative, right? So there are some companies that are going to gain, some companies are going to lose, right? That's one thing you're going to see. The other thing, what this is plotting is density. So essentially, this is I would say, a probability distribution function of what kind of losses are experienced by what fraction of companies, right? So that's one way to look at it. Now, it's like heavily color coded. You will see that there are basically 8 different curves, right? 8 different plots here, and that correspond to in some sense the two scenario providers that I talked about, GCAM versus Remind. It also has the variable of whether the net zero is to 2050 or net zero to 2070. And it also has a component of a shock year, which is now versus 2030. So basically, 3 variables with 2 values each that give you about 8 plots. And what I'm going to do on the next slide is kind of talk a little bit about what are the implications for different kinds of power companies in India. So what we get out of this, right, broadly, when you come and parse these graphs, and our paper kind of talks about, and the paper is also available if you're interested, the paper talks about what is the differentiated impacts of this potential climate transition risk on the Indian power sector. So what we see is that on average, substantial losses for fossil companies, whether it's coal-based power or gas-based power. Um, we see moderate gains for renewable energy companies, and that's solar, wind, battery storage, etc. And we don't see that much of an impact for hydropower or nuclear. And some of that is related to the modeling choices that are being made. But the kind of the key result is that there are substantial gains for fossil companies and substantial losses for fossil companies and moderate gains for renewable energy. And then you can start getting into some of the nuances and some of the numbers, but on average, if you look at the average loss for fossil fuel company, and if you look at the average loss for renewable company, and compare the two numbers, broadly, there's an overall average loss of about 50%, right? And this is because there are fewer fossil fuel companies and they experience higher uh, average loss, and there are a lot of renewable companies, so the average gains are much lower, and therefore the overall average impact is about 50%, comparing the two subsectors. We also see some other second order effects, which have to do with policy action. I will not talk about that here, and what I want to kind of continue focusing on is a more in-depth analysis, because what we have seen is now we are seeing this impact of renewables, as well as impact on fossil-based companies. Can we actually dig deeper into this? And this is what we start doing in this analysis here. So what we tried to do was we tried to look at the six major players in the Indian power sector, and we tried to look at basically this whole notion of the NPV impact on the equity, looking forward, and we're calling it cash flow at risk, but essentially it's an NPV metric. And what we try to do see is what's the kind of the likely impact of going from a current policies to a net zero by 2050, using the GCAM model. And what we do is we look at NTPC, which is primarily a fossil fuel company. I've also listed the different capacities for these companies, and hopefully these are accurate enough. Then Adani Power, which is mostly fossils. Then we have Tata Power, which is um, a mixed company, JSW Energy, which is also mixed. Mix means fossil and renewables. And then we have Renew Power and Adani Green. There are renewable companies, and we try to kind of do this more detailed analysis in mostly Excel spreadsheets. And what we find is this cash flow of risk is posted here, and what we see is the orange dots is the business as usual, which is the current policy scenario, and the green dots is the ambition scenario. Um, and and again, I plotted the change in valuation, right? So there's a zero on the y-axis, and then you see that there is substantial gains for purely green companies. There is kind of moderate impacts on mixed companies, but they are kind of negative, and then significantly negative impacts for fossil heavy companies, right? So in some sense, these results that are more detailed analysis, in some sense, and this is the firm level analysis, which is many of the equity analysts will do, in some sense, kind of substantiate what we see in the broad sectoral analysis, where we looked at all companies in a very broad sense. So that's the point I wanted to make. But again, as I was saying in the beginning, it's not just about risk or the loss of value. It's also about gains and increase in value, depending on where you're situated. All right, so and again, what are the implications of this analysis? Um, uh, it depends on one's views on how these results could be interpreted. It also depends on trusting the analysis, but assuming the analysis is correct, what should happen, right? So what it shows is that if there's a coal dependent or fossil dependent companies, and they're likely to see significant losses going forward, perhaps they should start thinking about transitioning the business to renewables. Similarly for gas power based firms. On the other hand, there's significant opportunities for renewable energy firms that could be exploiting. And these kind of implications for power companies translate to implications for investors. At some level, that does mean that investors should think about reducing exposure to coal power firms, and increase kind of exposure to renewables based firms. But the other thing also it's indicating is that there is a need to do more accurate assessment of risk, because unless you do this assessment for transition risk, unless you do this assessment for physical risk, you're unlikely to find out what is the potential risk on your portfolios, and therefore think about, for a financial institution, what should be done in terms of strategies or transition planning, which is a new thing that's coming up, that where we're also doing a lot of work. So uh, in some sense, this is what potentially RBI is also trying to figure out, is they're trying to ask financial institutions, especially the largest banks, is to do this analysis to sort out what is the likely risk on the portfolio, and also, potentially, what are then implications for macro implications in terms of financial stability, etc., leading to potentially policy changes, right? And the tool that I showed you in the beginning, which kind of looks at how a shock might propagate through the system, could be a useful tool for assessing that. So, anyways, for policymakers, I think the move by RBI on at least having guidance on disclosing climate financial risk is a very welcome move, and it should at least disclose information that's potentially useful for not only companies and financial institutions, but also to individual investors on how they want to invest in various sectors. Um, and obviously, there are implications for policymakers in the real economy sector. But I think that's all I wanted to cover in today's talk. Hopefully, this was useful. I try to keep it as high level as possible, but happy to answer any questions you might have.
Thank you, Dr. Shrimali. I think it was fantastic. And thank you so much for sharing your experience with us today. And I would say that not just for the audience, it was extremely insightful for us as well to listen to you. And I'm certain that this would be the case with the audience, would have found this talk very useful. Now we'll take some questions which we are getting from the audience, but I'll just like to remind them that if you have any questions to Dr. Shrimali, please uh, send us that in the Q&A chat box, and we'll take that up. But before I take up any question from the audience, I have a question from me, Dr. Shrimali. I think what you have done is a very successful transition, and this is a personal question. Please feel free to ask or tell whatever you want to tell, and if you want to not answer this question, that too is fine. But you made a very successful transition in terms of how you were working in the industry, then you got interested in sustainable finance. So, like, was it an event that led to this change in thinking, or it happened very organically because you saw the industry from very close quarters and then realized that there is more sustainability and, in general, focus on sustainable finance which is needed? So, please allow me to ask that question.
Thank you. I mean, the answer could be pretty long, but I'll try to be brief on this. So yeah, you're correct that I was working in the industry in the first 10 years of my professional life. And at some point, I always had aspirations to do PhD. Um, and I was also thinking about um, going from a individual contributor at a firm, could I make impacts at the larger level? And so that made me think about going to trying to do analysis or trying to do work that is impacting policy and regulation. So that was one of the kind of the major factors. In terms of the other transition that I have made, which was basically from high tech to clean tech in some sense, that has been informed by my just asking what could be the largest problem in this century for us to solve. Because and my humble opinion is that the climate, and you can see that it has been held true over the last 20 years since I made the transition, that climate is likely to be the one of the largest problem we're going to solve, not for ourselves, but also for our children and our grandchildren and the coming generations. So I'm happy to be here today.
Thank you, sir. There is a question from one of the participants, and Deepak Kumar is asking, how useful do you see NGFS in the Indian context? Do you see it adding significant value, or there could be potential to do that?
Yeah, so NGFS in the from the context of what is NGFS, I had gone through it a little bit. So what happened was some time ago, as central banks were starting to become aware of climate financial risks, there was a question around how can we create a consortium that provides the right tools for central banks to think about climate financial risk. And and one of the first question uh, that comes up is that how do you have scenarios? How can you create scenarios that are useful for analysis? And so NGFS was created for that. And NGFS obviously kind of started by creating global level scenarios. But increasingly, NGFS has become focused on regional implications. And it is starting to create scenarios that are focused on individual countries. So, for example, when I talked about the GCAM model, the GCAM model has an India module that is used. So whatever analysis we did, we did it for India focus scenarios that we could find in these models, and that's why we haven't used all NGFS scenarios. We use only GCAM and Remind, and there's increasing effort to create India specific scenarios that are more specific to India's evolution.
That's great. Thanks, sir. There is a question from Rashmi Mehrotra, and she's asking if the transition of physical risk can be quantified now and up to what extent that is possible, and why do they still need to be counted as non-financial and listed separately? It's a very interesting question. Over to you, sir.
Yeah, yeah. No, I mean, the whole idea is that the analysis that I'm showing is essentially showing that you can calculate it today, right? I mean, that's the whole idea. That given the scenario analysis that you can do, you can calculate it today. Um, Now, what the question, the second part of the question was, why is it not counted as part of the financial risk? That's a very controversial question and issue for now. Um, in some ways, you know, kind of disclosing these risks separately gives you a sense of what is the extent of this risk. But as I had also mentioned, these risks are not separate risks. They're also manifesting themselves to the classical channels that I had talked about: credit, market, liquidity, etc. So you can start seeing what are the impacts of these kind of factors on the traditional metrics that you look in finance.
That's interesting. And there is, of course, a lot of talk about how the technology changed. Because, let's say, if you look at even in India, last 20-25 years, there was a time when the entire focus was on wind. And then suddenly solar came up because the cost went down for panels. And sometimes people do wonder, like, whether the technology is evolving so fast and changing so quickly that it's very, very difficult to take a long-term call. Because, like, if you're setting up coal-based plant, you can take up a call for 30 years, 35 years. You're setting up a transmission line, you're setting up a call, like you're taking call for next 40 years. Is it really possible with renewables, or that's something which we have to live with? That's how it evolves, that's how it changes. What's your sense on that, Dr. Shimali?
Yeah, I mean, you have a valid point. And this is a classical investment decision, right? I mean, do you invest now or you wait, right? So, and especially in a space where costs are falling very quickly, that question becomes even more pertinent. But I think that is the question that has been I mean, like you look at cell phones, same thing happened, right? So would you have waited for 20 years to invest in cell phones, or would you invest now? So it depends on the market opportunity now. And to some extent, the market opportunity is highly linked to policy in some sense, especially for energy systems. So I think for the government to recognize, and the government has recognized. I mean, if you can see, the market opportunity has been provided in the short term by the 500 gigawatts by 2030 target for renewables, right? And the policymakers are working, and they're trying to coordinate to provide the right projects for investors to invest in. So it's all out there. But in that context, this conversation does come up, I would say, and it is used as somewhat of an excuse, I would say, as opposed to engaging in concrete action. Yeah.
I think that's a valid point, a very balanced perspective. Because, like, especially when you said that, like, uh, it happens with cell phones, right? Like every 3 years, 4 years, things change, but you can't wait for you to not buy one and then wait for 20 years when the final thing arrives. It doesn't work like that. Thank you so much. There is a question on it says a little generic, but what could be the key elements that are primarily taken into consideration when conducting a climate risk analysis? Of course, I don't know what the participant meant, but like that's the question which was there in my chat box, and I just wanted to ask you that.
No, no, no. I mean, hopefully some of my presentation gave that process or the procedure, right? And this is one of my slide on workflow also talked about it, right? But the basic, again, just to kind of summarize, what you want to do is you want to say there's a particular risk that might arise, right? Let's say whether it's a transition risk or a climate risk, physical risk. Then what you want to do is if you want to say, okay, the risk might arise and I want to assess the impact, you want to figure out what we call a baseline scenario versus a scenario, right? And then what you want to do is what is going to happen to a company between those two scenarios, and you're trying to figure out the impact, and that's how you calculate the impact. So that's the very simplified version. Now, to do that, what you need to have is for transition risk on one side or even physical risk on the other side, you need to figure out a sense of how the world is going to evolve around you. So it's like the state of the world evolving, right? Um, um, and the state of the world evolving through these integrated assessment models that are being used, or even climate models that are used, they give you a sense of how the world might evolve around you as it's material to you, right? So if I take the coal power company or a renewable power company, what I want to understand is under the scenarios that I'm looking at and comparing, I want to see how is the market demand for coal power versus renewable power evolving under these two scenarios, right? So the models give you that. And then you take those variables or the metrics that are important to you for your calculations and you plug it into your models. And that is the workflow that I've went through. And once you plug it into the models, you'll get these, your valuation under business as usual or current policy scenario versus the climate scenario, and you can look at the difference. But that's the high level thing. But similarly, you can do physical risk analysis where you could say, oh, if I have these increased floods with higher intensity, again, you could say, what is the likely impact on my capital stock if I have a power plant? Let's say there's a severe flood, it might damage my power plant, and therefore I might be out of operation for a while, or I might have to replace the turbine or something. So now I have a cost implications, right? And also I may not be able to produce for a month or 2 months or 3 months or whatever while I'm producing, replacing all this. So now my production gets impacted. So now you can see that your revenue is getting impacted, you're not able to produce, and you have cost implications. And all of these feed into your typical financial statements to give you some impact on your cash flows that eventually flow through. So that's the basic logic. Yeah.
I think that's a great perspective because sometimes the implications for even the ecosystem could be huge because like when the tsunamis came and there was a risk of a Japanese nuclear plant, Fukushima, it was very close to, and it was a scary situation. And sometimes these things also need to be factored in when we are looking at a technology like nuclear, because sometimes you have a situation where the things might completely go out of control because of climate related factors and because of climate impact, and that could be an interesting way to look at it. But moving on, there is I'm sure that like this had to come. How do you see AI or large language models like ChatGPT playing a role in assessing risk analysis, uh, maybe sector or company research from climate perspective? Do you see a role for that?
Yeah, I mean, the analysis is pretty quantitative, right? So obviously some of this could be automated. But one area where I have found AI and broadly these AI machine learning tools to be useful is when you're looking at disclosures, whether it's disclosures on climate risk or are there disclosures on and again what I mean by climate risk disclosure is companies are asked to disclose information on the measurements they have done on potential climate risk. So that's the measurement part of thing. But there's also a complementary thing that's happening in many countries, not there in India yet, but India does have the RBI disclosure does talk about it. They talk about strategies to address the risk. So that's also called transition planning. Um, when companies are disclosing, um, are their disclosures consistent? Are they greenwashing? That whole question of greenwashing comes in. And AI and machine learning can be useful to highlight greenwashing issues. And a lot of times, what you will see is a company will say, "I have high risk and I'm doing all this stuff, great stuff." But then you look at their actual practices, and the practices don't align with what they said they will do. So say AI and machine, there are tools that are being created on the site to kind of assess what our company's actions really kind of matching with their promises. Let me put it that way. So
Thank you. Just one last question because we are like very close to our closing time. Rashi Agarwal has a question, and she's asking, based on your work on climate transition financial risk modeling, could you clarify how international development finance is structured to enable climate-aligned investments, and what role private equity can play in de-risking and scaling such investments in emerging markets? Lot of keywords in this question,
lot
but
of
over to
stuff.
you, sir.
Lot of stuff. I mean, the this also connects back to so I mean, a lot of this stuff is happening. The climate risk assessment, I would say, is happening at the country level, right? What we talked about today, um, and it is primarily meant for regulators to assess their local risk. Yeah. Um, but obviously, this is a global issue, and there is this whole uh, space called climate finance, and that's another area that I work in, where the idea is that there could be committed funds that are flowing from the global north to the global south, and the role of the development financial institutions, right? Um, but within that, I think there's a lot of interesting stuff that is happening, can happen. I'll give you one example, right? Countries are now, especially countries that are likely to have high physical risk, are starting to raise what we call sustainability linked bonds, SLB.
Right,
They're sovereign bonds, and the idea is that the sovereign bond, the whole idea of the SLB is that the coupon payment is connected to how well the country is addressing its risks. It's measured through KPIs.
right.
So you can raise money in the global markets to say, okay, give me an incentive, give me a lower rate upfront, I'll manage my risk, and then you can adjust the rate over time. So that was just an example.
Thank you, sir. And it's a pity that because of positive time, we can't take more questions because there are pretty more in the pipeline. But unfortunately, and sorry to all the participants who have asked this question, and I could not include them in the conversation. My sincere apologies. But it was great listening to you, sir. And I would say that it was extremely insightful, and it is I do know that it's a technical topic, but the way you have described and simplified a lot of these terms, I think it was fantastic.